Over the past 3 weeks, the stock market has experienced a correction, reminding investors that stocks can move in both directions. After a nearly 2.5-year bull market rally, the Dow Jones Industrial Average, S&P, and Nasdaq have all retreated from their all-time highs. Despite his unwavering long-term optimism about the U.S. economy and stock market, Buffett's $173 billion warning to Wall Street over the past 2 years has been an ominous signal that trouble is brewing. Buffett has repeated on multiple occasions that investors shouldn't bet against America. Even though Buffett and his top advisors realize that economic downturns and stock market corrections are inevitable, they also recognize that periods of economic expansion and bull markets last substantially longer than downturns. Nevertheless, Warren Buffett's trading activity over short periods doesn't always align with his long-term investment philosophy. Berkshire's quarterly cash flow statement provides precise insight on how much in net equities Buffett has purchased or sold. Over the previous 9 quarters, Buffett has been a persistent net seller of stocks. Berkshire Hathaway closed out 2024 with a record $334.2 billion in cash, cash equivalents, and marketable securities. Altogether, Berkshire's leader has overseen the sale of roughly $173 billion more in stocks than he's purchased since October 1, 2022. In 2024, Warren Buffett's Berkshire Hathaway took an unprecedented step by aggressively selling off its holdings in Apple and other major stocks. This move caused Berkshire's cash pile to grow by an average of 16% per quarter, totaling over $300 billion. In Warren Buffett's latest annual letter to shareholders, he offered one of his more direct and chilling assessments of how he views stocks on Wall Street. Put bluntly, the Oracle of Omaha noted, quote, "Often nothing looks compelling." One of the very few trades Buffett is unwavering on is his value investing roots. Even though value is a subjective term that varies from one investor to the next, Berkshire's CEO refuses to buy shares of a company, even one deemed to be a wonderful business, if he doesn't feel like he's getting a good deal. With the stock market being historically pricey, it's becoming increasingly harder to find a bargain. However, this is not the first time Buffett's cash holdings have caught the attention of the media. When looking at the historical chart of Berkshire's cash reserves, we can see that when it comes to cash reserves, Buffett knows how to play his hand at the right time. Just look at the peaks of Berkshire's cash reserves just before a major economic correction hits. Berkshire sits on a pile of cash, the correction occurs, and then the cash reserves begin to dwindle as Berkshire begins re-entering the market at a substantial discount. This is buy low, sell high shown in cash reserves. So when the next correction comes, you can be sure Berkshire will be ready to unload its cash reserves again by entering new and increased positions in the market. That is, if Buffett can find something compelling. The market cap to GDP ratio, which has become known as the Buffett Indicator, has long been a favorite valuation measure of Buffett's. It's arrived at by dividing the cumulative market cap of all U.S. stocks by the gross domestic product. When backtested to 1970, the Buffett Indicator has averaged a reading of 85%. Put another way, the total value of publicly traded stocks equates to roughly 85% of U.S. GDP. In February of 2025, the Buffett Indicator surpassed 207, which is an all-time high. The S&P 500's price-to-earnings ratio, also known as the cyclically adjusted CAPE ratio, is based on the average inflation-adjusted earnings over the previous 10 years. Since 1871, the S&P 500's price-to-earnings ratio has averaged 17.22. However, as of March 11th, the PE stood at 34.76, which is more than double the long-term average. This high valuation is concerning, as the 5 previous instances where the PE topped 30 were all followed by at least a 20% decline in the S&P 500. Furthermore, on February 21st, the PE reached a level of 37.9. which is well over double the average of 17. This suggests the S&P may be overvalued and vulnerable to a significant correction. Warren Buffett's persistent selling activity shows that he's been expecting a sizable pullback in equities for some time. Based solely on historical precedent, there's a possibility that investors could witness an S&P and Nasdaq fall by around 40%. As customary with Buffett shareholder letters, he had much wisdom to bestow. Here he reflects his long-term philosophy. Quote, "Our measure excludes capital gains or losses on the stocks and bonds we own, whether realized or unrealized. Over time, we think it highly likely that gains will prevail. Why else would we buy these securities? Though the year-by-year numbers will swing wildly and unpredictably, our horizon for such commitments is almost always far longer than a year. In many cases, our thinking involves decades. These long-termers are the purchases that sometimes make the cash register ring like church bells." Finally, let's look at some indicators of recession risk in the United States. Here we have interest rates in the unemployment chart. Using Milton Friedman's point of view, that of low interest rates equals high risk in the economy, which equals economic contraction, not an expansion that is typically assigned to lowering interest rates. In fact, as you can see from this chart, nearly all recessions are preceded by a lowering of interest rates just prior and going into the recession. Starting at 1990, we see interest rates start dropping in 89, and then a recession the following year, which, as Friedman says, results in an even further lowering of interest rates. This is eerily similar to what is happening right now. One exception you might point out to this rule is that in the 90s, they dropped rates and we did not have a recession. This is an anomaly of sorts. However, looking at the unemployment rate of this time, we see it never spiked. You could also point to a lack of a 10-year yield curve inversion, as we have experienced for the past 3 years. But notice what happens during the next rate cutting cycle. It equates to a recession. Then again, during the GFC, we see the same pattern of interest rates dropping leading into the recession. Again, it is the same pattern in 2020. Today, the Fed is in another rate cutting cycle, which has preceded almost every single recession. Prior to the 1990s, the Fed's interest rate setting mechanism was different. However, we see the same pattern playing out in 1957, 61, 1970, and 75. The Fed started cutting rates in September of 2024, even before Trump was elected. From the unconventional stance of a Milton Friedman economist, I will reiterate that from his school of thought, these rate cuts are not the Fed or Gov trying to, quote, stimulate the economy. It is simply growth and inflation expectations plummeting, which almost always coincides with risk going up in the real economy, and subsequently bank lending activities going down. Put in another way, the low interest rates are merely a reflection of a contracting economy and tight money conditions. Getting back to the unemployment rate, usually around the beginning or middle of a recession, we get a huge spike in unemployment. And just prior to the recession, the unemployment rate very subtly and sneakily starts to eke its way up, trending slightly higher and higher before it really takes off. This rule is expressed by what is known as the SOM rule. The SOM rule states when the 3-month moving average of the national unemployment rate is 0.5 percentage point or more above its low over the prior 12 months, we are in the early months of a recession. If we notice what has happened since May 2023, we see that it has followed past cycles, where we see we may not be in a recession yet, but the unemployment rate is certainly trending higher, which is what you would expect if we are headed towards an economic contraction.